tertiary, your third, you have a break of structure, again using market structure here on the 1 hour, and your bands cross over here. That's your entry point. And when you go back to your primary, right, so looking back over to the left, when you go back to your primary asset, primary time frame, sorry, that would be your rough entry point there. Why does this matter? Why is this good? Why could this be optimal? Well, look at what this area represents. This would mean if you just take away all the noise and all the everything else about trend trading. If you're trying to get in on a daily chart for Solana, how else could you get in there? That has not broken above this high, so that's the market structure level. That high leads to the lowest low. So you would not be getting in for any other reason based on that. You have retested the bands, but you don't know where your invalidation would go if you're just looking at this daily chart, because again, it hasn't made a new high yet. It's had a low, but it hasn't had a high. So this, using the confluence of bands, actually gives you an earlier entry than you otherwise would on the daily. And that's the only reason to use them. If you could just get this entry on the daily anyway, then why bother? But if you were to wait for a daily trigger, you would have to wait for that structure level to break, which would not happen here, no closes. It closes there, finally. So that is significantly higher, 95 versus 107. It is also 10 or 11 days later, right? So this gives you an earlier trigger and usually a better price if tested correctly. So using market structure is very simple. It's just the same logic. Price pulls back into the bands. Because it's pulled back into the bands, it must have entered a downtrend on your secondary or your tertiary, and you use market structure to denote when that reclaims, and that's when you get in. By the way, as we go through this, these are all different system ideas. Your goal is not to use all of them. Remember, it's as little as possible, like minimum viable product, right? MVP, as they do in fucking product testing. You want to take as little as you need to be profitable and successful. So whichever of these catches your eye, go deep on that. Don't try and do every single thing I talk about here today. Confluence next. So confluence, all confluence is taking, again, a second piece of data or a second piece of technical analysis or whatever, and using that in combination with your primary. So in this example, you would use a confluence of volume, which is over here. And I'll explain why. And volume gets you a better entry than the bands would itself. So again, I'm trying to explain why any of these would be used within your own system, okay? So primary trend, 4 hour, bands cross, first touch, right? Bands cross over, we're wanting to buy the first touch as price goes into it. Here, as price comes down in on your secondary time frame, your 1 hour, price does a volume divergence. It goes down, price goes lower, but so does volume. That's a divergence. Right? Price down, volume down is a sign of a weakening downtrend. In an uptrend, if price is up, you want to see volume up because that's a sign of strength, generally. If price is going down, you want to see price continuing to go down with rising volume because that would be a sign of continued selling and strength follow through on the downside. So a volume div gives you an indication of a reversal. I would then combine that because, again, the thing with volume is not going to give you a trigger by itself without market structure, which is why we always come back to market structure. You can see the volume divergence, but it doesn't tell you where to enter, right? There's a volume divergence, but you can't just enter right away because it might go lower again with even lower volume. What do you wait for? Break of structure, or sorry, should be an MSB. My bad. Market structure break, which is what? The swing high before the lowest low, price breaks above it, candle close of this 1 hour candle, your secondary time frame. That's your trigger to get in, stop loss at the lows, very simple. How does that look on your tertiary time frame? Here will be your exact entry, right? At the end of that 1 hour candle, right as the next one opens. And what does that do? That actually gets you an earlier entry than waiting for the bands. Right? So as you can see here, the bands are still bearish on the 5 minute. You will get an earlier entry. Obviously, when the bands cross, price itself is around the same level, but that won't always be the case. There will be times where something like a volume div in a BOS will get you a better entry and it will get you a better price. Sorry, it will get you an earlier entry and a better price. Right. So that's volume confluence, number one. Next confluence is RSI, relative strength index. Quite a good thing to use in trend trading. So RSI, this works both on the upside and actually the downside as well, and maybe even better, which I should talk about at the end of this. RSI may be one of the better indicators to use for ending trends, longs especially, so ending bullish trends, because the nature of crypto participants is that they want it to go up. Obviously, we all want it to go up, right? Who doesn't want 100x? Who doesn't want a 50x, 20x, 10x, 5x, fucking 2x would be nice, right? Stuff doesn't do that in the downside. People don't really want to short. Crypto's supposed to go up. That's the whole reason why everyone buys it. Everyone here has a friend who's made loads of money on the long side. No one has any friends who've made any money on the short side in crypto because they're probably dead by now because they get blown out on fucking squeezes. And so the natural tendency of traders in crypto, and I'm not talking about day trading here, I'm talking about swing trading, position trading. If you're going to hold something for several, if you were, right, let me say, I put a gun to your head and I said, you have to open a trade and you have to hold it for 6 months in crypto. What would you do? Would you open a short or open a long? Anybody with a brain would open a long. This is not accounting for what stage of the market, are we bull market, bear market? The point is that crypto is a upwards trending market, and especially for traders, the best gains are on the upside. And at any point in any 6 month period, you could open a short and it could go in your favor, and then you get absolutely smashed and blown out by a short squeeze. So the biggest trends are always on the upside. That's why stuff can go up 100x, it can't go down 100x. Right? It can only go down 100%. 100x is 10,000%, give or take. So, with that said, RSI is great confluence for closing trades. I'll talk about it after, because people tend to ignore the RSI when it's in an uptrend, right? Price goes higher, RSI is showing weakness, but people want to ignore that because why? They want it to go up more. They don't want the party to end. They want more bull market. They want more profits. They're greedy and they're euphoric. So anyway, this is about entering, so using it the opposite way. RSI confluence, here is a 4 hour trend. Bands go bullish. So bands cross, 50, 100, 200 over here. First touch happens here on the 4 hour. This is just one way you can use it. But if you're looking for trend continuation, whatever time frame you're looking at, you want to have seen the first leg, which is generally going to be the first leg that happens before the first touch. The first leg will see the RSI usually go from oversold to overbought. That's how trend legs tend to move. That means it's going to go above 70. So, first condition, your primary trend has to have gone above 70. Then, it has to test the EMA. And the RSI should be below 50 when that happens. It's important that, because if you want to talk about like a bullish dip buy or trend reset or pullback target, it's not for the RSI to go all the way back to 30. That will happen on your tertiary time frame. That will happen on your secondary time frame. Your primary time frame, it should not go from 30 to 70 to 30 within the same trend in the first leg. That would be a sign of extreme weakness. It should actually, much like the chart, pull back into a higher low. 50 is a good target for that. 50 is like a classic sort of pullback reset where you can say, okay, that's an area to buy dips. Again, test this. Don't just take my word for it. But RSI, 4 hour uptrend, 50, 100, 200, pulls back, touches the band. RSI has been above 70, is now below 50. That's your first condition. That's your primary time frame. That's what you're looking for, right? Secondary, all you really care about here on the secondary is that your trend is intact. Is it? Yes. Right? Meaning 50, 100, 200, all still bullish. Great. And then tertiary is where you're looking at your RSI for the confluence. What does that mean? After the EMA touch, so the EMA touch happens here, right? You're looking for a bullish divergence to form, which forms when this low gets made, price goes lower. So price goes lower, which I'll denote with red. Price makes a new low, and RSI is based off candle closes, by the way, which is, again, I have a lesson on RSI if you want to watch it. Price goes lower. RSI makes a higher low from here at 24 to here at 32. By the way, the first part of a bull div should be 30 or below. ideally, meaning you want to make sure that it has actually reset and then made a higher low. Doesn't really matter where the higher low is. The higher low can be below 30 as long as it's higher than the, previous touch. What you don't want to do is look at like this here, where it comes back to 34 and then makes a higher low at 39. It doesn't matter what price doing there. You want to see it hit 30. Full reset is the best rule for that. So you have your bull div, and then you have to find an entry, right? So again, just like volume, just like any divergence, the divergence tells you that there could or should be a reversal. It doesn't tell you buy right away, because again, you can't just buy on that very next candle open, because it could easily go lower, right? The bull div itself, as you can see here, was also developing here. At this point, the bull div was, I hate this with TradingView, it's so annoying. This was also a bull div, right? Price went lower, RSI made a higher low. If you didn't wait for a price confirmation, if you did not wait for an entry trigger, you'd have bought there. Why would you not, right? It's a higher low. Surely you should buy. No. That's why you don't just blindly take the RSI itself and use it. It will perform extremely poorly if you don't combine it with price or the bands or something else. So you get the EMA touch on the 4 hour. Your 1 hour trend is intact. Your tertiary, your 5 minute, has a bullish divergence. And then you wait for some confirming signal. In this example, I used the 1 hour swing high. So the swing high before the low. I used that and had a MSB. So on this candle close, right over here. That is where I put the entry. So that was at the candle close of this candle, which is over here. That's your entry. That also gets you in before the 5 minute bands cross bullish. So again, a slightly earlier entry, which is the idea of these confluences. Otherwise, just use the fucking bands. There you go. That's how you can use RSI in combination with the moving averages and market structure. There's going to be three elements if you use confluence generally. There's going to be the bands, market structure, and your data. Well, it's RSI, it's volume, it could be delta, like cumulative volume delta, CVD. It could be open interest divergences. It could be liquidation divergences. Some of the things I talked about on last week's weekend workshop. Anything that you can see that creates a divergence can be used as the third part. Whatever you like the look of, whatever works well for you, whatever tests well, use that. None are better or worse than the other. It's all context dependent, right? It's about where and when you use it and how you use it. So that is RSI. This is fib. This one's really simple. And I'm going to show like the most basic example to begin with, which is wait for when the bands cross, wait for a pullback, use the fib from the lowest point of your primary trend to the highest point. This is just one time frame, by the way. Lowest point to the highest point, fib retracement, 382 to 618. Why? Because that's apparently what fibs are, right? I'm not a Fibonacci trader. I use them very, very sporadically. I see why they have value because they allow people to define risk. I'm not a big believer in the golden ratio or the golden zone, or that it has to be, fucking mathematically it's guaranteed to happen, because it doesn't, right? If the golden ratio was a real thing, it's a real thing in nature. Yes, this is how you get the fractal nature of a leaf. That's why a leaf looks the same as, the veins on a leaf look the same as the leaf itself, which if you zoom out looks the same as the branch, which if you zoom out looks the same as the tree. We all know the fractal, spiral, repeating patterns in nature. It's all real. That is real. The Fibonacci sequence is real. Yeah, okay, fine. But the logic behind it being like, especially the 0.618, which is the golden ratio, which is the magic area, for people who believe in it in the markets, it would then have to work all the time for it to be a rule, right? So it's not a rule. It's not like there's a law of the market where the 0.618 always works. So if something doesn't always work, then that means it can work sometimes. If it means it works sometimes, then you run it through testing and you treat it as a probability, not a certainty, okay? It has a probability of being bullish or bearish, whatever trend you're in. And so there's a zone. Shallow pullbacks would tend to be that 38%. Deeper pullbacks in a trend would be no more than the 618. If it goes beyond that, 70, 75, 80, that's when you're looking at this is no longer a trend. This is most likely below the bands. This is most likely breaking market structure. It's most likely no longer a trend. So you would have a zone between 382 and 618, and then within that you would have to obviously choose your exact entries. Do you buy exactly on that, on the touch with the candle close that holds it? Do you buy, when it's at 50? Do you buy at 618? You would have to combine it with some other form of secondary signal. But the logic, trend leg, bands are bullish or bearish, obviously, but this is a bullish uptrend. Trend leg, bands are bullish, pullback occurs somewhere between 382, 618. If it's going to be a trend, that's where it should be.